Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about DR Horton. The symbol is DHI. Today we'll discuss, did we score or did we fumble? Brian Overby. I'm the senior options analyst with Ally Invest. Before we jump into the stock play of the day that we did on Monday, let's look a little bit at the markets. I think we need to address the markets just because they've been so volatile over the last couple of days. Right now on my screen, I'm showing that the NASDAQ is down 2.25%. The Dow is down 1.5%. We got the SPX down about 1.7%. They had similar numbers yesterday, down a little bit more than that. But the thing that I wanted to highlight today before we review the trade from Monday is the VIX index. We see that has spiked up to 3291. It's down a little bit, or down just a little bit today, which is overall a fairly decent sign in the marketplace. But on all of the stock play of on the Monday stock plays of the day, we've always highlighted the fact that the VIX was stubbornly staying around that 25% range. Now, the VIX is based off of options in the S&P 500 index, and a lot of people will call it the fear index. And usually when the S&P 500 index is setting new highs, you see the VIX down in the new lows area. Now, what does it mean that the VIX just would not come off, would not go down? Well, it just means that there's still a lot of fear and uncertainty, even though we're rallying to new highs in a lot of the indexes and a lot of the stocks. So when the sell-off comes, which it has a little bit, September and October are traditionally some of the most volatile months in the marketplace. And lo and behold, September 1st hit, and a few days later, we got some volatility to the downside, ideally right after the Apple and Tesla split. And the VIX index has skyrocketed up. It's good that it's came off a little bit today, but we're still up above the 30 range, which is traditionally, back in the day, that would be considered extremely high volatility. So I'm just going to highlight that volatility, the marketplace is still thinking that the volatility is going to stick. I have a watch list here that I make up of VIX options that I like to follow. And the VIX index in general is just it's considered a spot price. There are options that trade on the VIX, but a lot of those options will follow what's called a futures contract. So we do have indexes that track futures, and you can quote them at Ally Invest, and here's the symbols for them. But we're seeing the September expiration up around 33.30, a little bit higher. But what's interesting to me is that the October expiration is actually around 38%. So it's 5 volatility points higher than where the current market is at. And if we go all the way up to December, the marketplace is expecting this volatility to stick around. Now, want to emphasize that volatility doesn't mean that the market's going down or it's going up. It just means that if it does go down, the tendency for it to go down big is larger when implied volatility is higher. And also to the upside, if the market is going up, the implied volatility, if it's higher, means it implies that the swing to the upside could be higher than normal. And that's what implied volatility is all about. So I thought that was worth mentioning. We've been talking about the VIX every Monday on the stock play of the day. So let's get into this week's trade. We looked at a short put spread in DR Horton, symbol DHI. So on a short put spread, this is the Ally Invest options playbook. The stock is usually trading above the short put strike. So the stock on the profit and loss graph would be somewhere up in this range. All right, we sell a put saying that we want the market to stay above or continue on up, right? So it's a neutral to bullish strategy overall if you just look at the put spread. But we also talked about, well, some people will do this because they want to buy DR Horton at a lower price. And this put would mean that I'm willing to buy 100 shares of DR Horton at that strike price. So some people will do it with a goal of buying the stock at a lower price. Some people would like to do this and hope that all the options expire worthless and you make the net credit on that position. And we talked about both of those in the Monday stock play of the day. Well, considering that what the markets are doing, obviously most stocks are down, and DHI is also down in this situation. So what might we do with this position? So here is a 15-minute, 5-day DHI chart. And I've highlighted here that usually we do the stock play of the day every Monday at noon Eastern time. So this is noon Eastern on that chart. So this was at noon, stock was around 71.60. And I just highlighted all the way across the screen where the stock was at when we looked to put on the trade. So this would be Tuesday, all days trading. This would be Wednesday. This would be Thursday. And this is where we're currently at on Friday. So obviously the stock has dropped off a lot and has actually done a lot of damage today. The stock was actually fairly good overall, all the way up until it wasn't right here on the Friday's trading. So the stock is now down towards our short strike. We sold the 68 strike and we bought the 65 strike. So I have that inside the Ally Invest live option chains. We have the put right over here. When we did the trade, we looked at the October 2nd expiration. Now we went out a little further in time and I talked a little bit about if you're speculating on this trade and you're just trying to make the net credit, going out further in time gives you a little bit of protection. If the position goes against you, it gives you a little bit of a buffer. It allows you an opportunity to get out at a minimal loss to start with. So that's the concept of going out a little further in time, especially if you're not trying to avoid an earnings date or anything like that. And we're not in earnings seasons. As you can see here on our chains, the earnings date has not been declared yet in DR Horton. So with that said, 68.20, it's down $2.36. What could we do? Well, we could stay the course. We went down to 68. So at that point in time, we're right at that strike price. The position, if I scroll down, is trading at $1.31 net credit to the account. So if we did this today, the credit would be $1.31. When we looked at the trade, I'm going to round it off a little bit. I think it was at 67 cents net credit, but let's call it 70 cents. So on this position, we're down about 60 cents. We're down almost as much as we brought in when we sold this short put spread. So the concept, if you're trading and you're kind of speculating by doing short put spreads, you should probably think about getting out at any point in time. A lot of times my goal when I'm selling short put spreads is that if I sell it for a net credit of 70 cents, meaning that's my maximum gain, I want to get out when I'm down that 70 cents. So if it gets down and is trading for close to 140, right, that would mean that I've lost the amount of the maximum gain that I could make on the trade. And a lot of people would think about just getting out of that trade at that point in time. If you're looking to buy the stock, well, ideally you should be okay with this because the markets came down to that strike price and you're hoping that you might put that stock and buy 100 shares of stock at 68. If that's your outlook, you can just let this trade ride and hopefully you get put the stock and then you are long the underlying stock and you would want the market to obviously go up at that point in time. So there's two different ways that you can approach this underlying. Now, I'm going to talk about just something a little bit today that if I were to do this trade and the market would come down to the 65 level, if that stock does get down to the 65 level, that means that option contract that you own, that you bought for protection, is going to have its highest premium because it's an at the money option contract. And that's where a lot of the quote unquote juice is at. So whenever it gets down to that 65 strike, especially if I'm thinking I want to close out that position, I really don't want it to go much lower than that. That would be the lowest that I want the stock to go and get out of this position if I were speculating on a short-term trade. Now, we said we didn't want to do a 2-week option contract because if that had happened and it goes against us, there's really not much we can do. So hence the reason why we went out to the October 2nd expiration. We still have 28 days remaining in that option contract. We could close it out. We could move on. We could stick around and see, gosh, maybe I can buy 100 shares at that 68 strike price. And that would be my goal if I liked the home builders going into the new year. So that's going to be it for this edition of the Stock Play of the Day Overtime. Every Monday, we tape the stock play of the day, except this Monday, because it is a holiday. So it's going to be a week past this Monday before we're back for the stock play of the day. But please click subscribe and ring the bell, and you'll get all the notifications for the stock play of the day. Thanks for coming.